All right, what's up, everyone? We're going to go over the credit spreads chart layout here. We've got the S&P 500 on top, and we've got a credit spread measurement here on the bottom. This honestly can be one of the most important chart layouts that I've got, especially when it comes to determining, risk appetite in the market and potential clues and signals into where the stock market could be heading. Now, this is a market internals chart. Okay, so this comes in the market internals chart layout package. You could call this a little bit of inter-market analysis, but basically this chart compares the performance of the S&P 500 via the SPX with credit spreads. Now, these aren't credit spreads like options trading, okay, and debit spreads and credit spreads. This is specifically the ratio of high yield corporate bonds, HYG, to intermediate treasury bonds, the IEI. Now, investors use credit spreads to assess the risk sentiment in the market. Credit spreads are the difference in yield between corporate bonds and comparable maturity government bonds. Wider spreads indicate a higher risk aversion among investors, suggesting they demand more yield to compensate for the higher risk of corporate bonds. Narrower spreads suggest lower risk aversion and higher confidence in the economic outlook. So, when the credit spread widens, it often signals increased concern over credit risk. Right? This is typically a bearish signal for the equity market, as it suggests investors are less willing to take on risk. Now, if you've got narrowing spreads, all right, this indicates improving investor confidence and a higher willingness to take on risk, which is generally bullish for the stock market. And there are divergences in this. Now, these divergences between the S&P 500 and credit spreads can signal potential changes in market trends. Let's go ahead and take a look, right? And so we've got the S&P 500 on the top here. We've got our credit spread measurement here, right? And we see the S&P 500 is rising as the credit spreads measurement here is actually making lower lows. So we're making higher lows here throughout this period, but we've got a low, lower low, and lower low here. This is a divergence where we're seeing them do two different things, and it suggests that the stock market, right, underneath the surface, investors are getting more risk off, and we see this as a signal that really started and was a great signal to potentially watch out for as we headed into the bear market, right? The most recent bear market that we've gotten, that we're out of now, thankfully. But there are plenty of other times, right? You see here, the stock market's making a high and a higher high, but our credit spreads measurement is making a high and a lower high. Again, this is a divergent period here, and we see a sell-off in the S&P 500 afterwards. Same thing over here. Now we've got a bullish divergence, okay, where we're making a low and a higher low in our credit spread ratio. We've got a low and a lower low here. So this time, this is a signal that we could potentially be going higher in the stock market, okay? And so this is really how you want to use this chart. Over here, we had this divergence period where we were making lower highs, but the credit spreads were making higher highs here. And that was a signal that, hey, potentially we could be rising and start to make higher highs again. And sure enough, we did end up doing that. And if you look at where we're at currently, right, we are making new highs in the S&P 500. We're not necessarily making new highs in the credit spreads ratio here, but it's still rising, right? We see a rising credit spread ratio chart here and a rising S&P 500. So we can feel relatively good about that. If this continues to make lower highs here, as this continues to make higher highs, then that's going to be another divergence and a signal that, hey, maybe risk appetite is not as bullish as we think it is, as the S&P 500 is portraying it to be, and we could be potentially due for a pullback or correction in the market. As I mentioned in the beginning, this is going to be probably one of the most important ones that you want to pay attention to if you're really looking for one chart, right, to really let you know, hey, are there any things that I should be worried about right now, right? Because there's so many different charts and so many different things you can look at that can give you false signals. Credit spreads, I think, are going to be one of the best. All right. And if not the best, to really just give you your one-stop shop of, what is risk appetite? What is investor appetite at the moment? Are there any changes in, that appetite that are not being portrayed through the broader market indices that maybe I need to pay attention to? And if so, what are those? Can I easily identify them? And I think you can easily identify them. I've showed you guys here how to identify them. And you can do them on your own heading forward in the future. Thanks for watching. All right, if you enjoyed this video, I've got many different chart layout packages. This is one of them that comes in the market internals chart package. It may be included in the intermarket analysis package as well. I haven't decided yet. But many different packages that really focus on different ways to look at the market, gain an edge in the market, and really just start doing some institutional grade analysis, and a lot of things that your average retail investor aren't exposed to or aren't aware of. That some of the big dogs, as they say, some of the big guys on Wall Street, are paying attention to and potentially using to give themselves an edge.